Panic amid global markets. Has the 18.6-year cycle peaked? Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. Today, welcome back, Drew, and we've actually had a lot of requests for him to continue looking at some of this stuff because he brings such an excellent framework to this. How are you going today, Drew?
Good, Chris. How are you?
Very good. As I said, lots of people have been asking. They really want your opinion on some of this because so much has been happening. Let's start off by talking about the market volatility. Obviously, recently, the tariffs, the retaliation to the tariffs, the turning back. I saw a funny meme that sort of had Trump on the phone saying, you know, the tariffs aren't working. What do I do? Turn them off, turn it back on again. You know, like what's going on here? Talk to us a little bit about that and your view, particularly around the bond market, of what's really happening with this volatility.
Yeah, absolutely. So overall, across all markets, we're seeing a massive increase in volatility. Now, obviously, these are because of what's happening with the tariffs. But rather than looking at a news perspective, zooming out and looking at the cycle and where we are in the cycle, it is expected to have an increase in volatility in both directions towards the final stages of the 18.6-year land cycle. So as we're coming towards the final stages of the winner's curse, where there's an increase in volatility, all markets are rising together, you do see greater swings, massive corrections in both directions, and you see an increase in emotions amongst market participants as well. So extreme fear, extreme greed, swinging back and forth, and then that leads us into the final peak. Now, what's important to do at this stage is one, not get too caught up in the fear and in the greed and the emotions of it all, but also to not just sit back from a cycle trader perspective and say, you know, all is well, this is where we are in the cycle. You really can't get too complacent. This is the time in the cycle to keep a really close eye on things. And by that, I mean mainly technical indicators, cycle indicators, failed cycles, and then continue keeping an eye on sentiment, because as you get closer to this peak, it becomes increasingly challenging to navigate. So while zooming out tells us to remain calm, to not get caught up in the news headlines, to not get caught up in the volatility of price and emotions, it is an important time to keep an eye on the cycle, to try and start hunting for cycle peaks in a macro sense. Now, from everything that I've seen zooming out, I don't believe that the peak is in right now. But from a timing perspective, technically it could be in any time between 2024 and 2028. So these really are the years to keep a close eye on breakdown of price structure, and not to get too greedy in terms of wanting the cycle to go on longer than it actually is going on.
And I think that's the area people find most challenging because a lot of people will agree with your idea there that you really need to ignore the news and you need to follow the longer term cycle. But the challenge comes for the other part that you were talking about, where you go, well, we also need to be paying attention because the cycle top could come at any moment, effectively. Like it could be anywhere between here and a number of years away. So the timing of this becomes challenging. And the tendency for a lot of people is to go, well, if that's the case and the cycle top could be coming around here, if we see a big move like we have seen recently, how do I know that isn't the top? Because yes, I mean, you have that opinion yourself that we're probably not there yet. But I suppose maybe there's some value you can add for people there. How do you come to that opinion yourself that we're probably not there yet? Because I know we've had many conversations around this where I believe the same as you. I don't think this is the top of that bigger cycle. But what metrics are you using? You mentioned whether you're looking at some technical indicators or whatever, but how are you getting to your capability to sleep well at night that we're not there yet?
Yeah, I keep my technical analysis pretty simple. So I'll bring up a chart of the S&P 500, just looking at the biggest stock market. Now, the recent move has been nothing short of extraordinary. But zooming out, let's see if we can have a look at this here. So WD Gann, he's a technical trader from about 100 years ago. He's got a few different methods. One of the really simple methods that he employs is the 50% tool. So looking at a macro move, you look at the 50% range of that, and it's amazing. You can test this across any market, across hundreds of years, and they, like a magnet, come back to the 50% level and usually bounce off it. Now, the theory is, and this has been back tested and proven very, very very thoroughly. The theory is that if it hits the 50% and it's closing above the 50%, then it's in a macro bullish position of strength. The bullish structure is intact. So looking here, I'm not sure if you can see my cursor, but that's the macro low, late 2022, the global liquidity low. This is the peak that we just hit, and this is the 50% level of this entire macro range. And you can see, anyone who's looking at a more zoomed in view, who's looking at a weekly chart, you see this weekly drop and it's terrifying. But you zoom out, you draw a 50% line, and you see it's exactly hit the 50% and bounced off it in a very strong way. This shows bullish strength being intact until further notice. Now, this is why it's important to keep an eye on this, because if this rolls over and we start getting multiple weekly closes in this gray region here below the 50%, that's your early warning sign that the bullish strength is no longer intact. Now, that could just last a few weeks and we get back above and hold above. And in that case, you've got to have the agility to flip back into bullish. But the look at right now is very strong and very bullish. I mean, it's bounced off this to the a pinpoint, and is holding up pretty well over here. So if we continue seeing consolidation in this region, I'm not too concerned. And if the S&P is holding strong, that says a lot about the macro cycle. But look, the 18.6 year land, it's a land cycle, right? So let's have a look at the land markets here. I generally track the home builders ETF to give us an idea of where the land markets are in America. Now, this is the late 2022 macro low. That's the peak. And once again, 50% level. It went below it. It wicked below it, but you can see the close is right on it and it's closed above it. Now, this is looking not as strong as the S&P. And generally in these macro cycles, you'll see the home builders ETF be a leading indicator. So again, it's strong right now, but we might see a lower high, we might see a double top, or we might see new highs. That's yet to be seen. But it's one of those things where until further notice, I'm not too concerned. If I start seeing closes below this level, that's when I start really paying very close attention, because you might see weakness in the land market before you see weakness in the stock market. A really important point is that while most of these markets bottom together, they all peak at different times and they all start turning down at different times. And in the previous cycle, the land markets were a leading indicator to the stock markets. So I'll just quickly pull up one chart showing the previous 18.6 year land cycle, and that's this chart here. Now you can see this divergence where the S&P is in this sort of peach color, where it continued making new highs, and the land markets were already collapsing, already putting in on the weekly time frame a break in trend, a low, a lower high, and a lower low. And the S&P was still putting in a double top over there before things really started rolling over. So the fact that we haven't seen a break in the 50% level of the home builders ETF, let alone a macro trend change of lower lows and lower highs, and we haven't seen a divergence between the S&P and the land markets as yet, is giving me a lot of comfort. So from a technical perspective, 50% levels are intact. From a technical perspective, we haven't seen divergences across these major markets as yet. That's one thing. In terms of the volatility, it is characteristic to see higher volatility at these phases of the market. That's the second point. And finally, sentiment is absolutely rock bottom. So when you're seeing extreme fear in markets at these dips, that is not very characteristic of the peaks. Usually when you see the first dip, you might see fear come in, but it very quickly moves back into greed on the complacency bounce. And that's sort of yet to be seen. We have spent an extended period of time in the extreme fear region. So just based on sentiment, based on technical analysis, based on the characteristic volatility that we're seeing, so far, I have no major reason to be concerned. But like I said, it's something that you keep an eye on, and new data is coming in every day to sort of make that decision. And I will just comment with the bond market as well. We saw a huge spike in the 10-year bond yields, but generally, that has not caused too many issues. And what I'm looking at with that as well is probably a macro lower high and a rollover. So looking at this here, we see that major trend line going back to October 2023. It broke out of that. And then the short-term trend line it broke out of as well. So this has got a lot of people very concerned right now.
Mm.
It's testing that first level of support. I don't think it's going to hold. And then you've got the second level of support as well. Generally, that's a high, lower high, lower high. The bond market does have a tendency to sort of freak people out. I mean, if you drew a trend line here, you would have seen a very similar thing where it broke out and then broke back down below. So it does have a way of running people's stops and then letting the trend continue in the original direction. I do think this is just going to roll over from here. And look, one final thing I will say as well. I know this has probably gone on a little bit, but there's so many charts here we could look at. One final thing I will say is the DXY. Um, Looking at the dollar index should give people a lot of confidence for markets as a whole. Um, Looking at the 50% tools as well, this is the DXY. That's the low from 2021. So you saw this huge run up in the DXY, and this whole range here looks to me like a macro distribution that is, over multiple years, so very powerful. And then looking at trend breaks as well, just like the S&P and the home builders ETFs are holding up above those macro 50% levels, the DXY is broken down from every macro 50% level. So you look at this low here and this high here, which is this uptrend. The 50% level is here. And again, right on point. It's broken down. It back tested it to almost to the exact decimal point, and it broke. That means this uptrend is gone. This uptrend is no longer intact, and obviously it's broken these lows as well. So that's that this was your early indication when it was here that this uptrend is gone. But breaking these lows has obviously confirmed that. Looking at this entire range from this low here, from 2021 all the way up here, this is the 50% level. It's now broken down from there as well. Now, we're probably at some sort of low here. I would not be surprised if it goes back up and back tests this macro 50% level. If it gets rejected there and continues down, which is my base case, you'll see this completely fall off a cliff. That means you've got a macro high and a macro lower high, and you've got a macro low, and you're probably working on a macro lower low now. So the DXY breaking down from this 50% is your early indication. The DXY breaking down from this 50% was your indication just before. And bringing it back to the 18.6-year land cycle, why this is important and why I think it's still not at the peak is if you look at how the DXY behaves over this final stage of the 18.6-year land cycle, it's very compelling. Now, this chart is a little bit older. You can see it was drawn when the DXY was at 104. We're at 99 now. But this is why cycles are important. This gave us a lot of confidence early on that this was probably some sort of lower high, way before it even hit these lows. This green bit is the final stages of the 18.6-year land cycles. And you can see it generally falls off, fell off. And the expectation is that it falls off here. And that's conducive to all assets going up together, all markets rising simultaneously, leading into that complacency, leading into that winner's curse phase. Whether you're holding land or stocks or bullion, everything's going up, and you feel like an absolute genius. But generally, what happens is that complacency leads to a broad-based collapse, and that leads into the collapse phase, which is this red phase here. In that phase, most markets will struggle, but gold and silver perform really well in that phase because here they're benefiting from a falling DXY. Over here, they're benefiting from a flight to safety requirement. So most markets do really well in this green phase, but it's only really bullion that does well in this phase. So looking at the 18.6-year land cycle, we're sort of somewhere here right now. The DXY is broken down from all its, the 50% level of this range and this range. And the idea is that if this uptrend is broken, the next lows that I've got in sight are over here, which is the 89 level, and then possibly a further downtrend, which we'll take it one step at a time. But if that keeps falling off, that shows us that there is that final DXY fall off phase of the 18.6-year cycle still to come.
There's so much to unpack there, and that detail of analysis is what I know people are asking for. I want to dig a little bit more into gold and silver with you, but I might actually leave that, and we might do another video on this with you this week if you're happy to do that. That we'll put out later in the week as well, just to really dig into that angle of it because there's so much there. But I want to go back to one thing that you were talking about with the bonds, because this is an interesting point from my perspective to go, how does that fit in when you think about the risks at the moment? Because you highlighted this. There are real risks at the moment that those yields get effectively out of control and keep moving to the upside. Bonds keep somewhat collapsing. And that potentially is consistent with what you were talking about with the US dollar. If we have a move generally away from the US dollar as the not necessarily saying we lose reserve currency, any of that, but just a move generally away from the US and less need for the US dollar weakens the US dollar. Some of those sort of fundamental reasons that would back the technical discussion that you've given there. Does that align, or probably another way to word it would be, how does your perspective on the end of this cycle line up with what we see happening right now with the dollar and bonds? So could a bond collapse, or at least bonds falling well and truly out of favor, line up with what you're talking about with that broader cycle that's in play?
The general macro expectation around bonds is that the yield continues falling, and so the bond collateral values continue rising. That's conducive to an increase in global liquidity as well, because if collateral is gone, looking a lot healthier, then banks can issue more debt, and generally there's more leverage in the system overall. So with that, you'd expect the yields to drop and the collateral values to increase. That is in line with the DXY falling as well, right? So the DXY falling, the yields falling, and the collateral values rising is the expectation for this final stage of the market. But what's interesting about this 20-year cycle that's ending is that it's actually ending in parallel with a 80-year cycle as well. Now, the 80-year cycle ending sees shifts in macro superpowers or dominance. So it would not be surprising to see a macro shift or a macro reduction of US dollar dominance. Not saying that we move away from the US dollar as a reserve currency, from a one cycle to the next, but they might just see a little bit of a shake up in terms of that assertion of US fiscal dominance. Now, the point that I'm making is that as you move from a 8-year cycle to the next, it doesn't have to behave exactly like moving from the previous 3 20-year cycles to the next. We might see a few of these things move in slightly different ways that are difficult to anticipate, where we see a little bit of a disjointing in how different markets move. So that's where gold comes in. You might see gold and silver be the ultimate beneficiaries of any of that turbulence, where what's worked for the previous decades is suddenly not working anymore. And that's why we keep coming back to gold and silver as a solution to not just 1 20-year cycle to the next, but 180 to the next, is because they've been around for thousands of years. So as you move from a centennial cycle to the next, you do want an asset that has been around for thousands of years. So if we see some sort of reduction of US dominance in terms of the US dollar or US government debt, which I shouldn't say if, because we are seeing it play out in real time, you're going to see gold and silver benefit from this. And you can already see that in central banks. Ever since 2022, the rate of central bank stockpiling gold has gone up by 5x. So there's clearly a concerted effort to move away from US government debt as collateral and to move towards something that allows for a little bit more geopolitical sovereignty. And that'll continue as we come to the end of this 8-year cycle. And the last one was the Great Depression and the end of World War II. So we're sort of at a similar phase now.
Yeah, that does answer my question, I think, because we could have both things be correct. As you sort of point out there, we could have a scenario where like you would expect bond yields to fall, you would expect rates to fall under the model, but I think you're saying that there is still potential that we have a blow up here, and it would still fit within the model. It wouldn't break the model, because that's the kind of thing that you expect to happen at the end of this type, or the intersection of that even longer term cycle with the long term cycle that you've been talking about.
Yeah, because the DXY, it's just the US against a basket of other currencies, so it tends to have an inverse relationship or a certain type of dynamic play out. But you could see a situation where the DXY is not acting as normal. Like you've seen the DXY go up with gold and Bitcoin, and whether that's the dollar milkshake theory or whatever sort of playing out. But really, the DXY is the dollar euro. So you could see the euro gaining strength as a beneficiary. You could see gold gaining strength where the DXY is falling off, while bond yields are spiking. Right, that'd be a really interesting dynamic. Not a normal one that we've seen in our lifetimes or even our parents' lifetimes. But, people need to be on alert that what's worked for the last 10, 20, 30, 50 years is not necessarily going to work for the next 5 or 10. And when all that uncertainty is on the table, it really comes back to gold and silver. So the expectation is that DXY falls off, it raises all markets together. But what's happening in the US bond market? I mean, it's probably just people, covering their positions, and really just like every low in an uptrend, every macro low feels really scary. In an uptrend, every macro high in a downtrend feels quite uncertain as well. So we're probably just at a turning point there. But like you said, I wouldn't be surprised to see those relationships play out slightly differently if something happens in the next 5 years in the bond market. Um, that would be in line with the 8-year cycle expectations.
Yeah, and to be clear on that, I agree with you. I don't think that this time will be different there, but I just want to have in my mind the possibility that it could be. And if it were to be different, because certainly we are at that very peak fear moment where you look at those markets and go, this could be a real problem. That it still fit with the model, and I think it does. From what you said today, I can certainly see a future forward either way, where that model still plays out. So yeah, look, fantastic conversation as always, Drew. I know there are people waiting for that, so they'll be very appreciative of your time on that. I will get you back later in the week and we will discuss, I think, probably the gold and silver angle of that a little bit more deeply, particularly around the US dollar, because that's fascinating to think about what could be on the horizon there. So thanks for your time. Thanks for your work on that as always today, Drew.
Thanks so much, Chris. It was good to chat to you. And next time we'll probably dig into silver a little bit more as well for anyone that's waiting for that one.
I'm always keen on that one as well. Thanks everyone for watching. We'll chat again soon.